Hey guys, welcome back to another episode of the Multifamily Investor Playbook. I'm Mark Faris, and I'm here with my co-host, John Makarewicz. The mission of the show is to be the ultimate guide for high net worth multifamily investors. And today we're going to be sharing all the reasons why real estate is such a great investment. We've worked with thousands of investors through the years, and there's some common reasons why real estate comes up. So we're going to be going over some of the major things that investors are looking for when they are investing and how real estate delivers on that. We're going to be overcoming some myths as well on some of the challenges and when investors think about investing in real estate. We're going to be sharing what some of these myths are or challenges and how we actually overcome them with our investors. John, it's great to be here with you today.
Mark, I'm so excited to be here. Really excited about this topic in particular. I've shared with you that, I spent so much of my career in residential real estate that I had this fear of investing in real estate, just kind of thinking about, I survived the Great Recession, right? And so I was like, well, if something happens, I don't want to lose my income and my investments. And, in hindsight, that was not the right thinking. So I'm all in on real estate today. So I'm really excited to dive into this topic and share some of my experiences and, share with our investors, why real estate, in our opinion, is the strongest investment you can make.
Yeah, it's so interesting, John. This is the number one regret that I hear with most investors that I speak with, pretty much like with real estate agents, with entrepreneurs, is like, what's the number one lesson? They're like, I should have bought more real estate. And actually, that was one of the main reasons why I started investing early in real estate, is because when I was speaking with all these entrepreneurs that were at the end of their business cycle, at the end of their career, most of them would tell me, you know what, Mark? The business was worth less than the real estate in the end. So they said, you know what, make sure you buy the building. Whatever your business is in, buy the building and then have your business operate out of the building that you own. And that's generally been worth more than the business. Now, don't get me wrong, you can scale a business and do extremely well, but if you want a surefire way of doing well, just buy and hold real estate. So, part of the reason why we're doing this show here is to educate and to help investors have more confidence to take that step, because that's ultimately the major cause, is just an unknowing, or maybe you don't have enough time, or maybe there's not a good real estate deal, or even if there was a real estate deal, is that the right deal? Is it in a flood zone? Are the tenants going to destroy? These are all natural and they're real concerns that if you don't handle them properly, it will keep you out of the game. Unfortunately, if you stay out of the game, you won't be positioned the same way as if somebody actually took the step forward. That being said, you want to make sure that you take the right steps so that you don't step in we'll say a landmine, and it will knock you out of the game, right? So we're going to be sharing why real estate is done so well, and moving forward there, what are some of the main reasons why our investors are doing extremely well, and we've seen investors through the years do well in real estate.
Yeah, I mean, I literally kicked myself, speaking of the Great Recession, I'm in Metro Atlanta, and there were homes you could buy for $50,000, $60,000, and the land today is worth $400,000. Like, forget about the house. And so I think back on all that. So I'm one of those with those regrets. But about 5, 6 years ago, I got smart and started diversifying into real estate. And as I've shared previously, I'm all in on real estate going forward. Just a firm, true believer. And it's interesting you share that example, but there was a brokerage in Atlanta that went bankrupt during the Great Recession. But what ultimately saved the owners was they owned all the buildings in which, they operated their brokerages. They had 8, Class A office buildings all throughout Metro Atlanta. And so that was definitely a lesson that I
Yeah.
paid attention to.
Well, and John, yeah, I think no matter, even if you did get into the game of real estate, you wish you would have bought more, right? There was that day you just got distracted and you didn't end up buying that building, or, you ended up walking away from the deal because the seller wouldn't drop another $5,000. And ultimately, we all look back and say, I wish I would have done more. And so I'm of a firm belief that 10 years from now, we're going to be looking back at today, and we're going to be saying, I wish I would have bought more today. And especially in today's market, we're at the beginning of 2025. And this is a time that it's not a sexy time to buy real estate. If you go to the news, real estate is not in the public's, we'll say, good graces, or in the news good graces right now. And it is in the past, from what I've seen, times like this is the best time to be buying real estate. And a lot of the data, well, all the data that we're analyzing, saying that it's got in that 2, 3, 4 year time frame, real estate has such strong fundamentals on, and especially multifamily, why it's going to do well. And we'll do another episode basically proving that thesis out. But today's going to be more diving into what are we've interviewed and talked with thousands of investors through the years, and there's some common themes why real estate is the investment of choice. And so we're going to be going over that. And the first and foremost, the number one thing that investors like about investing and why real estate is the area that they gravitate to is that it, for capital preservation, is such a strong place to invest. And so they don't want to lose money. So they know that if they buy a piece of property and hold it, and if they follow certain fundamentals, it's not likely that the value of that investment is going to drop, like say the stock market, where one day you wake up and it's dropped 5% or 10%. In real estate, if you hold it long term, it is a great capital preservation investment.
Yeah, I mean, it's really truly one of the best hedges against inflation. And, specifically when we're talking about residential real estate, where people, raise their families and lay their head down at the end of the day, it's a core human need. And, we have challenges across the United States and Canada today with housing supply. And so buying into residential real estate, just, outside of maybe some market driven black swan event where a major employer or something happens in that specific area. I think about Detroit as a great example where it was so reliant on the auto business that when that started to go down, and it's very cyclical, it's got some up down, swings. Detroit actually has some upswing happening right now, but it'd be a market we would not be interested in just because if you look at it historically, right? So, it's one of those where often in investing, there's no guarantees, but the closest you can get, in my opinion, is real estate.
Well, at the peak of inflation, it was like at 7, 8%, right? And so what that does is it actually erodes your purchasing power. So, every year it actually, you can buy 7 to 8% less. And even now at 3%, every year that say you have 100,000 in the bank, it will buy 3% less goods and services a year from now. And so just by keeping cash in the bank from a capital preservation standpoint, it is we'll say a weaker way to preserve your capital. Whereas with real estate, the benefits of investing in that is that rents will go up as the value of the dollar goes down. And so that's a great hedge, and it preserves your purchasing power, which ultimately is most of our investors, their main thing is they don't want to lose money, right? So capital preservation. And so the beauty with real estate, especially if you're in a market where there's no rent control, so you can go in and raise rents as the value of the dollar goes down, rents will naturally go up. So it's a hedge against inflation, and it allows our investors to maintain their investment, their capital preservation, and their purchasing power. So
Yeah. And just to add to that example, you mentioned that 7 to 8% inflation that we were experiencing post pandemic. In the past 2 years since the pandemic, starting in around 2021, real estate values on average in the United States have increased about 40%. So 20% a year, right? So that 7 to 8%, look what happened right within the value of real estate. So, there's a real world example that we're in this moment.
that's right. And so that brings me to the next point of higher returns. So the reason why real estate is such a great vehicle to get higher returns than, say, the stock market is because of leverage. And so what I mean by that is that if you put 20% down on an asset, you can leverage something 5 times greater than that. So let's just say, for example, you buy a property, multifamily property for, we'll make it easy, $1 million. You put $200,000 down. Well, if that asset goes up by 5%, right? So it goes to $1,050,000. Well, you increased your investment by $50,000, right? And you put down $200,000. You got a 25% return on your investment, not a 5% return.
That's right.
And so leverage is such a powerful way. And so it's a form of infinite banking. So the way the bank works is if you put $1 in their deposits, bank can actually loan out $10 for every deposit that it has, every dollar it has on deposit. And so with real estate, it's a form of leverage like banking is. And so if you want to get into a better business, I'd say that maybe the only investment that's better than real estate is banking. If you want to get into a great business, own a bank, because they'll for every dollar that comes in, they're loaning out 10, so they're getting a spread on each of those. And so the higher returns in real estate is a form of a big form of leverage. And so this is how you can actually get higher returns in real estate.
Yeah, and really understanding the concept of leverage is, critical to success. But, it is such a powerful thing, right? I mean, I can't remember the Greek philosopher, right? But give me a lever big enough and I'll move the world, and it's really truly what you can experience with real estate when you get the right debt and you structure it the right way and you have all the due diligence done on the front end to kind of have at least a good crystal ball into what the future might look like. It is truly one of the more powerful forces in the world.
Yeah, and you're so right. I mean, you do need to do it the right way. But if you like all the reasons why real estate is so strong, we're going through that with you, and we'll make sure that we do another episode on how we're protecting the downside. But just super high level, if I was just to give you, John, like if you just do these three things to protect the downside before I move on, because that's the big question that is probably in a lot of listeners' mind right now is, okay, but if the market goes down or if the tenant, if they make a mess, or if you just do these three things will protect your downside. So I'm just going to hit them right off the bat, John. So if there's maybe any objections that are in the minds of listeners right now.
Yeah.
Number one, if you buy properties that have fixed debt. So you go in and you lock the rate in for 5 years. Now, that's a lot of the reasons why a lot of operators now are in trouble, because rates doubled and they're in trouble. So lock in your debt, have adequate cash reserves. So 6 months of principal and interest and 10% contingency on the renos. And then last but not least is cash flow. If you buy properties that cash flow from day one, you are insulated. So that way the property is maintaining itself and then you can go in and renovate. So just follow those three rules. That's a big one, which brings me to that next point. The benefits of investing in real estate is that it produces a monthly income for you. And so cash flow is something that I got to see as the market shifted. I got to see how important that was firsthand when you are buying real estate. I started seeing operators not be able to float the asset anymore because their interest rates went up. And in the past, they've just, taken personal income, and we call it like feeding the deal. Well, when you get into the bigger assets, you can't do that. I mean, you can only go to a certain point, but eventually the piggy bank has to close, right? And it needs to be self-sustaining. Yeah. And so the main difference between real estate compared to some other assets like, say, gold and silver is that real estate spits off extra. Not only is it maintaining, it's an inflation hedge, but it is spitting off income on a monthly basis. And so that brings us to the point, you want to make sure that you buy properties that cash flow or carry themselves.
Yeah. And that cash flow is critical because even in the event of, say, a housing recession or some sort of a downturn where the value of the building goes down, you're still collecting rent and that property could still cash flow. Because if you look at rents historically, in the Great Recession, going back to that era, there was about a 1 year period in '08 where rents did dip nationwide, but very nominally, a few percent. And then in '09 to 10, they just started going back up because it was hard for developers to get new, debt to develop and build new buildings, and so we ended up in a housing crunch, right, on the rental side as well as the rent or the ownership side. So, it's that idea that even in a temporary or a recessionary period, you can weather that storm and come out the other side. And so your plan maybe on a 3-year hold or a 5-year hold may become a 7, but you'll still come out on the other side in great shape. And we saw that, right? I mean, what happened post-recession? We saw one of the strongest real estate markets. It took about 4 or 5 years to get out of it, but once we did, that period from 2012 to 2020 was exceptional. And then even with the pandemic, right? I mean, I don't think anybody really saw that coming, and nobody knew exactly what was going to happen. And I know for myself in March of 2020 in April, I was pretty scared. But look what happened 2 years later. Home values increased dramatically. So, that ability when you have that cash flow coming in, you can weather that storm, right? And that consistent income also just becomes a great way to create, that passive income. And, one of the best books I read last year on these topics was The Algebra of Wealth by Scott Galloway, and he has this really interesting definition of wealth, and it's really the idea that your passive income is surpassing your burn rate. So in other words, if you spend say 30,000 a month, that's what it takes for you to live your life. Your goal should be, I need to get 30,000 in passive income coming in, and then your salary is just gravy, right? And think about the freedom that you'll have in your thinking and your thought. The stress will be reduced, and you'll be so much better at your job. Or if you're an entrepreneur like so many of our listeners are, you're not concerned now with money. You're thinking about, how do I improve my business? And so that monthly income is just such a powerful component to real estate investing.
No, for sure. And that's where if you can get your cash flow coming in and you're getting 5 to 7% in cash flow, cash and cash return, and you are forcing appreciation in a building going up, like, not only is your investment spitting off cash flow and getting a return, as with a lot of these fixed incomes, they'll get lower returns. Like maybe it is 5 to 6%. It seems to be a conservative pay, but your net amount that you have invested, like your original investment, is actually going up in addition to getting all this cash flow as well. So you're getting the best of both worlds. Your main net worth is growing and you're actually making income. So it's the best of both worlds there for sure. So the next one is time investment. And so this is a potential objection that investors have, is like, listen, I just don't have time. And so this is one of the main reasons why we launched Faris Capital, is because where I had come from in Canada, the area that I was living in no longer cash flowed. So the properties just weren't making any more money. And so I started looking around North America and started realizing, wow, down south in the US, these are properties that are still cash flowing from day one. You can buy a property. And then when you started getting into the larger multifamily space, 50, 100, 200 units, these properties are cash flowing. And not only that, they're much easier to manage with one location. You have full-time property management. And ultimately, there's less potential risk if you get one bad tenant, right? And there's no rent control. So all the reasons were pointing that I needed to move. And the reality is that in the market that I was at, most investors have a full-time job, or maybe they're retired and they don't want to have to fly back and forth in some of these other markets that are actually better markets to invest in that does cash flow. So we needed to build a vehicle that removed that potential objection, saying, you know what, just properties don't make sense anymore in the area that I invest in. I'm just not going to invest. And so this really removed this potential objection where you can get into real estate with low time investment. And that's what Faris Capital is all about, providing that bridge.
Yeah, no, and that was my thing. I mentioned the income, an investment component, not wanting everything wrapped up in the same industry, which in hindsight, once again, was the wrong way to think. But the other component was a busy professional scaling a business. I was a co-founder, and we had a big goal in mind to, exit this business. And so it was round the clock. And so, candidly on Sundays, kind of my day where I typically, had a day off, I didn't want to have to be messing with real estate or, looking for it. So once I discovered the ways that you can invest passively through whether syndications or forming an LLC with a partner, the light bulbs went off, because it's a way that I can spend a little bit of time researching the operator, researching the investment. But once that investment's made, I can just sit back and wait for the quarterly and monthly reports to roll in and ensure things are going well. So that component is a huge one. And I think a lot of our high net worth entrepreneurs listening to this, if you're not currently doing it, you need to be thinking about it, because, it really is truly passive.
Yeah, 100%. The next one that was important for all the investors, as we talked to them through the years of what was important to them, was they want to invest in something that's tax efficient. And so this is something that if you live in the United States, there are more tax advantages than if you're living in Canada. Now, in Canada, there's still tax advantages. You still have depreciation. But the beauty with these benefits investing in real estate is that the government wants you to invest in real estate. And so they allow you to have certain benefits, and depreciation is one of them, which basically means that you can, over a period of 27 and a half years, you can depreciate the value of the building. So take the value of the building, let's just say you buy $1 million property, and let's just say that 800,000 is in the building. Well, that 800,000, you can divide that up over 27 and a half years, and you can depreciate that over 27 and a half years. And so every year you can take that depreciation amount and you can offset your income and lower your income to be able to pay less taxes. And so keeping more money in your pocket is, we'll just say, a much better thing than giving it to the government, because we all know that we're going to do a better job spending our own money than the government is, right? I mean, just, it's crazy. You hear all these stories. It's like $1 billion was lost, or they overspent by $1 billion, or they left billions of dollars in another country in war equipment. Like this stuff is prevalent, right? And so this is something that, when it comes down to taxes and keeping more money in their pocket, that's the number one expense that most investors have, is taxes. And so I spoke to a really smart investor one time. He said, listen, if you spend more time focusing on how to mitigate your tax exposure, that is the best return in time investment that you can put in. And so real estate just gives you a lot of great options to be able to take advantage of those tax incentives.
Yeah, 100%. And $1 billion here, $1 billion there. We're just scratching the surface of the United States. I mean, we have like a $680 billion, military budget. And I don't think the Pentagon's passed one audit, in years, right? And billions just missing, the old thing of the $40 nails or whatever. But it's that ability to save on those taxes, which then you can deploy into investments, right? And then, it's like Mark Twain said, the idea like compound interest is like this magic thing, right? And so, putting that money to work for you instead of giving it to the government, who's going to spend it on wasteful things, or, just straight up graft, right? I mean, unfortunately, it happens in all aspects of life, but in the government, certainly, right? There's a lot of fraud and scams and people. So yeah, preserving your capital is the critical component to success in wealth building.
For sure. And if you're listening from the US, you get bonus depreciation, which allows you to even condense that time frame of 27 and a half years down to, you can basically, that first year, it was at 100%, and then you can actually, they brought that down a couple of times since then. And so they have bonus depreciation, and then you have cost segregation studies that allows you to actually take certain portions of the building and actually condense that time so that you can actually get more depreciation and more dollars to offset your actual income. And so not only that, you have the 1031 exchange, where you can take the actual gains in a sale of a property and you can roll it over to a like-kind investment. And so you can actually push down the tax payment down many, many years. And so that's just such an advantage, because the less tax you pay, even if you're going to pay it eventually, you can grow that dollar much faster if you're not taking a piece of it off every time you make a sale. And so that tax efficiency is one of the major reasons why investors love investing in real estate.
Yeah. And with the cost segregation and the bonus depreciation, that was originally a Trump administration program. And so, Democrats came in, they sort of sunsetted that. So this is a prediction, but with Trump back in office, I suspect we'll see that program extended and probably put back to its full capacity. So that is a prediction. We don't know 100% what's going to happen, but I suspect we'll see that. Of course, Trump's a real estate guy, right? So he gets this stuff. But the ability, you mentioned the cost segregation. I mean, that's something, when I learned about it, we can take our building, for example, and when we look at it, there's the real estate and then there's personal property, where things like granite countertops are considered personal property. So this cost segregation study occurs where they break everything down to the dollar. And so we can take out things like, the cabinets, the countertops and all those fixtures, and it just massively increases your ability to write down your taxes. So it's just another clear example. I know it's a little bit stronger in the US, but even what's offered in Canada just makes it a no-brainer. And that 1031 exchange that we have in the United States is just phenomenal because, yeah, you're kind of, kicking the can down the road a little bit, so to speak. But, keep in mind, if you're investing wisely, you're getting that cash flow coming in. So that cash flow continues, but you don't have that capital gains hit until you fully exit out. And so rolling that investment dollar over. So at Faris Capital Partners, our US investors can do that. When we exit a deal, we set it up in such a way where they can reinvest into another deal, whether with us or someone else, hopefully with us. That's our goal. And that's, one of our big missions is to have industry leading repeat and referral business. And that's because we want to do such a great job that our investors just, can't wait to do more business with us, right? With the service and the updates, et cetera. But that is such a huge advantage and another reason why real estate is the best investment out there.
For sure. One last thing on tax efficiency. The way we structure our distributions is return of capital. So that's another form of tax mitigation. And so what John was talking about like capital gains when you sell, that is something that if you don't take advantage of a 1031, you will pay capital gains, which is the best kind of tax you want to pay. It's better than regular income tax. But all the distributions that our deals, the way that we structured for investors, it's return of capital. So at the end of the year, you get your K1 in the US or T5013 if you're a Canadian. And so you're getting at the end of the year, but you don't have any sort of tax payment that you need to make because you're pushing it until the sale, pushing it back until the sale. So again, you're able to keep more dollars in your pocket, which, John, when I structured, we spent a lot of time at the beginning, as you know, making sure that we have the most tax efficient structure. And so that was one of the major things that we set in play right at the beginning on structuring in a way that allows our investors to keep all the distributions in their pocket, and there will be a tax, say, event at the end, but it'll be in the most efficient way, and it'll be down the road where you're able to keep more money in your pocket as you go along. So definitely tax efficient is another reason. Moving on, no liability. This is something that is very important for, if you're a high net worth individual, you don't want to be sued, right? You want to make sure that whatever you invest in, you want to make sure that your exposure to liability is down to, like, you want to keep that minimal, right? Zero if possible, right? And so you don't want to be sued. And this is something that came out quite a bit. So what we did with the structure of this, because anytime you go in and buy real estate, whether if you are you can buy it in a holding company or LLC or a limited partnership or however you structure it, which there's some personal, we'll say, protection there for sure. But the way that we structure our deals with our investors is that, so it's a general partner, limited partner structure, is that the limited partners or the investors that come in have no exposure to any sort of lawsuits other than their investment that they are investing. And so that's why they're called limited partners, because they have limited liability. And so coming in on an investment and partnering, say, with a group, any syndication group, but how we structure ours, we'll talk about from our experience with Faris Capital. You're coming in and you don't have that exposure the same as if you came in and bought your own property. If there was a lawsuit, you need to personally deal with it. Whereas in this case, us as the general partners, we sign on the loans and we are at exposure there essentially for any sort of lawsuits. And that's another form of mitigation of liability and making sure that you're structuring the deals in a way that removes that potential concern for investors.
Which is just amazing when you really slow down and think about it, because, that ability to own a apartment building, partially, right, or fractionally, but have zero risk outside of the investment dollar you put into the investment. There's not any other investment that I'm aware of that allows that outside of maybe the public markets. But, we've touched on this on previous podcasts, the way, I would think about it as an investor, a limited partner coming in, is while I, don't have liability, you may think, well, I don't really have the control either because this operator's doing the deal. And so it's critical that before you invest, you do a lot of research and due diligence on the operator themselves and, build that trust and make sure. But at the end of the day, you have access to, everything we are looking at prior to making, an offer on this building. So our due diligence, in other words. So you can independently do your own research and, verify the assumptions we're making. And that control component that comes with real estate investing is so lacking in the public market. So for me, it's that peace of mind of knowing that, I built trust with this operator. I've reviewed their due diligence. I've done my own independent research. And so, it gives you that feeling of, security that is so often missing in investing.
Yeah, trust is such a big factor when you're going in and investing. And, John, this is something that as we started scaling and building the team, I realized more and more the importance of having a team, especially when you're getting into the larger assets. Because, the reality is that there's skill set for finance, there's skill set for tax, there's taxes, and then there's skill set for acquisition and underwriting these deals, and then there's skill set for asset management. And so that brings us to the next point, that a lot of the high net worth investors that we work with, they say, you know what, I want professional guidance from a proven expert that's actually in their corner. And I'll share a quick example of how it can potentially go sideways. And so I actually interviewed and hired a property manager. This was a few years back, John, and I was speaking with him, and he was starting to tell me a little bit about how some of these REITs and companies work, is where they'll actually go in and buy an asset, like a B-class asset. So, what we like buying here at Faris Capital, they'd buy it in a holding company, and then they would do exactly the business plan, their own way, but they would execute a business plan to renovate and improve the asset. And then what they would do is they'd actually sell that same asset from the holding company to their own REIT, where the retail investors are investing. And so they've scooped off all that upside from the deal, and then they're passing along a fully stabilized asset that will generate perhaps, say 5 to 8% returns, but we'll say the juice was already squeezed out. And
Yeah.
so that is a group where, if you're coming in and you trust that, they're going to maximize the return, well, that's not happening. And so we wanted to build a company that investors could rely on us to be able to say, go out and maximize the returns, get the least amount of potential downside risk, mitigate that for me because I don't want to lose money, but I'd like to get those 20% returns. Go to the wall for me because that's really important, that I have a professional guide that is actually in my corner and telling me the things that I need to know. And that's really rare to find that out there, John. But when you find them, man, what a difference in your being able to sleep well at night, but then in the overall returns as well.
Yeah, I mean the team component is massive, and it was one of the first things we did. We went out and we hired the best in the industry. Finance, asset management, acquisitions, marketing, etc. We wanted to have the best people, the smartest people, and frankly, people that were better than us at these things, right? And so, such a huge component. And like in any industry that is experiencing a lot of growth, you'll start to see a lot of new players rush into the space. And starting around 2018, that occurred in this industry. And there's some fantastic operators out there. I mean, I'm invested. I invest in with other operators, as well as within Faris Capital Partners. And I do think it's important to note that Mark and I invest in the deal alongside our limited partners. So our capital's on the line alongside your capital when you invest with us. So, we're incentivized for our investors, but, behind the scenes, we also are putting our money at risk. So, it just really doubles that incentive to ensure that we're providing, the exceptional service and returns we promised. But what happened is a lot of these groups that started, it was folks that maybe had some capital, some money, maybe they had found success in other industries. And so, you would see guys from like, Silicon Valley. And there's a term for it. I can't remember. It's like the crypto bros or whatever in Austin, Texas. And in fact, if you look at Austin, Texas as a great example, so much investment occurred in that market. It got overheated, and they're seeing like negative rent trade outs of 5 to 6% now. I'm not a betting man, but if I was, I would bet on Austin. But I share that because a lot of that was just a lot of people with money just saying, "Oh, I'm going to get into apartment syndication," and those operators are in trouble because what they would do is take on, floating rate debt, and thought the good times would never end and the 2% interest rates, and then rates tripled, and now their deals are challenged. So, for us, Mark and I have spent our whole careers in real estate. I mean, I got into this business at 22. I think you were in that same age range, 21, 22. So our entire careers have been spent in real estate, and then we surrounded ourselves with people with 15, 20 plus years experience doing their specific thing, asset management, acquisitions, et cetera. So yeah, it's a critical component and definitely part of any investor's, due diligence process.
Yeah, for sure. And by stacking the right people, then you're essentially you're able to take advantage of these larger assets, which really are, there's less downside and there's just more upside in these investments. But you really do need a team. One person can't be an expert at everything, and even if they are, they don't have enough time. You really need to divide and conquer, and that's one of the benefits. Both John and myself, we scaled tens of millions of dollars in our companies in the past, and I think being able to tie together talent, but then to maintain them and to pull everybody together within a strong culture, and then driving towards a mission that is really about delivering an ultimate experience for our clients. That's something for us, it's the residents, but then also driving, as a byproduct of doing a good job for residents, we're giving the ultimate experience to our investors as well, right? So
Absolutely.
definitely that professional guidance is key that, most, if not all, I would say, high net worth individuals are looking for that. Somebody that's going to be in their corner and tell them the truth, right? That's what I want as well. So
Yeah, it's such a frustrating thing to learn, and I think you shared a story with me where you had invested in a startup. It wasn't a real estate venture, but a startup company. And if I remember the story correctly, you learned about it going bankrupt in the newspaper. Like nobody even called to let you know. And, I will say I have placed some capital in some real estate investments, and, by all accounts, things are going well. But I feel like it's once a year that I get an update, and it's like I have to reach out to my accountant who brought the deal to me and say, "Hey, have you heard anything about, oh, let me go see if I can find a quarterly report." And it's just frustrating not knowing, and so that's where at Faris Capital Partners, we guarantee monthly communication on the 30th of each month, 28th for February, but the 30th of every month. So you can set a clock to it, on the 30th, you're going to get that update, know exactly what happens. And we share the good news, the bad news, anything in between. And, we just want to make sure it's a totally transparent update, because, things happen. Sometimes things you can never predict, whether that's, a property manager that, we have for a month or two and realize that they're not great at their job. And, we see a dip in occupancy. We're going to let you know about that, but we're also going to let you know what we're doing about it. And that's replacing that person and bringing somebody else in. I remember our Largo investment where, after we closed, we knew the irrigation system wasn't working, and we thought we knew why it wasn't working, but we come to learn that the well that it was feeding from had gone dry. So we had to dig a new well. So it was a $20,000 expense we didn't account for, but because we drove down expenses on everything else in our budget, we were able to absorb it no problem. And now we have a beautiful irrigation system that'll work into the future with, flowing water. And so at the end of the day, it was a good thing, but, certainly not something we expected, but our investors were made aware of it, so they know exactly what's happening.
So tying together with a few other things, if you just look at your own net worth right now, where you have we'll just say the majority of it, it's highly likely that majority of it is already in real estate. So some will say financial advisors say, you know what, you need to diversify, get out of it. It's like, I'm more of the camp of do more what's already working for you because it's proven. Right now, of course, you need to make sure there's some liquidity just in case there's an emergency. But at the end of the day, I'm a huge fan on do more of what's already working, and let's not try to recreate the wheel, because ultimately, if you're getting 5% returns and another investment's getting 20%, I mean, that's where it can get massive. And I'm going to share a quick, we'll say, point here to really drive this point home. So the question is for you, how much would you lose over 30 years earning 10% instead of 20% on $100,000 investment? Is it A, $5 million, B, $12 million, or C, $21 million? What is the what's it going to cost you, or we'll say how much are you going to lose over 30 years investing $100,000 getting 10% compared to somebody else getting 20%? How much less will you have? And the answer is C. It's 21,992,690. It is crazy the difference by getting an extra 1 2, but 10% is massive compounding over that time frame. And so it just goes to show you the cost of inaction, the cost of just staying in something that's comfortable versus making sure that you're maximizing your returns.
Well, I was gonna guess C just because, I didn't know the answer to the question,
I set that one up, right? For
but it's
for a big
like, 'cause
number.
it's like, is this a trick question, right?
Yeah.
But like at the end of the day, like that is so shocking. And even if you thought about it this way, like our investments, we're targeting a 20% AAR. But let's just say there was some black swan event and we gave you 15. I mean, look at that compared to say 10. I mean, it's still a massive difference. And, you know, I remember when I was in my early 20s, somebody who was very wise that I looked up to told me, you know what, just put your money in, one of those Vanguard, targeted retirement accounts. And I actually did that for about 5, 7 years and I was pretty happy. And then, I started looking at real estate. I got a financial planner and then all of a sudden I was kind of mad, And so, there's a lot of folks out there that are trying to sell you that, that approach, just stick your money in a fund somewhere. And look, I have some money in mutual funds, right? I think it's important to diversify and to not put all your eggs in one basket, so to speak. But, once you have a comfortable base, which, thankfully at my age, I've been able to accomplish, like I don't necessarily worry about retirement because, the exit that occurred, it was a very fortunate and blessed thing. And so that's taken care of. But now I'm thinking about wealth creation, not comfortable. I'm thinking about,
Mhm.
candidly, what I think a lot about is my kids and my grandkids, because let's
Yeah.
face it, with the world changing the way it is, we're just scratching the surface of artificial intelligence and quantum computing. I do have a level of concern about not necessarily my children's ability to find success, but just are there opportunities in the future, right? It's going to be fewer jobs for more people. And so understanding that, building wealth is a critically important thing for me. And I know you're the same way, Mark.
Yeah.
I want to have a legacy for my family, such that, they know they don't have to worry about the basic things in life. And that's my goal in investing.
Yeah, for sure. It's really important. This is when you're looking at real estate as an asset. Here's another interesting fact is that real estate actually represents 60% of the world's mainstream assets, totaling it was at $280 trillion. And so that's 60% of all the world's main. So this is above equities, this is above any sort of debt products out there. All that combined is not as much as real estate. And so it's we'll just say it's the most prevalent investment that's out there and is one of the major reasons why it's actually created 90% of millionaires. And so the question to ask yourself is why, with all these benefits, why do you think that you haven't bought more real estate? It's a really good question, right? And say 10 years ago, do you wish that you would have bought a property? Well, the question's going to be is in 10 years from now, do you think you're going to think why today? And so that goes back to that question. Why do you think you haven't bought more real estate? And so here are the major reasons why people don't buy. So number one, their money's tied up and they're satisfied with the returns that they're getting. Or maybe they're just like, it's too much, the financial advisor, they're going to put too much of a stink. I just don't want to bother with it. It's making 5% is fine. Well, you can see what the cost, what that's costing you, right? With that example that I shared earlier about getting 10% more, it actually is massive dollars. So money is tied up and they're satisfied with returns, with the returns. That's one. Number two, they're too busy, right? They're just, I can't actually stop to breathe right now. I don't have any time. Three is they feel they missed the market, right? It's too expensive now. I missed the real estate market. And so I can tell you right now that if you speak to any builder out there, their costs for building is perhaps labor costs have gone down a little bit now, and material slightly, but not much. That material cost is actually is not dropping drastically. So any sort of new builds, they're not going down down in price, right? Like they're staying the way they are. So the question is do you think real estate is going to go up more or not? And so the thesis really is it's going to be more expensive in the future. And so that concern that you miss the market is not based on factual. It's not based on history, and it's not based on all the facts that we're identifying right now. Just go speak with with any sort of builder, and they'll tell you. The next one is not. They don't want to have tenant headaches, right? If you think about it, you're like, I've heard too many horror stories. I don't want to deal with tenants, and this is where, John, you share like some of the benefits of having the larger unit count to be able to help mitigate that.
Yeah, it's really where the magic happens because, if you own a single family rental property and your resident, just stops paying rent, depending on what market you're in, right? In many provinces in Canada, you could be looking at 18 months to go through that whole eviction process. There's states in the U.S., New York, California, that are very similar. Even in states like Georgia that have a very quick eviction process. Within the city of Atlanta, they're just backed up. There's just a backlog, so it takes time to move through. And so when you have that, all of a sudden, that rent not coming in, now mortgage dollars are going out, expenses for the property are going out, and it could actually jam up what could have been a really great investment. And so when you have 100+ units, you could absorb, 4, 5, 6 tenants, that are problematic or lease violations or aren't paying their rent. And on top of that, bringing in professional property managers, it gives us access to tools that the average investor doesn't have. So we're doing deep background checks. We have anti-fraud detection. Mark, it's insane. You can go on websites now, and I don't know what websites they are. I just know that they're out there where you can literally get like a fraud kit, right? So fake IDs, fake pay stubs, fake bank returns, fake tax returns. So if you're like an individual operator on your one property and you see what looks all legit and you sign off on it, there's a term for it. We call them professional tenants. They're people that understand the system. And you've shared examples with me on some of your assets in Canada where it's like the people get the system. They know how it works and they come in with bad intentions. And so when you have a couple hundred units, thinking about our Charleston portfolio, we could drop to 72% occupancy and still be breaking even. And today we're operating at 95% occupancy with minimal bad debt. Bad debt being the term we use for, rent that's not being paid, right? And because in South Carolina we can move quickly towards eviction, if somebody stops paying their rent, 15 days later we can file, 45, 60 days later they're out and we can bring that new tenant in. So, it's not to say single family rentals aren't a good investment. I think it should be something investors should consider, especially close to home. And, one strategy I know you and I've talked to young folks about, when people come to us, we're at these conferences and they're 23, 24, and they're trying to figure out how to get into real estate investing. You say, well, go buy yourself a duplex, live in one side, rent the other. Then eventually you move out, and so there are ways that you can make money and they could be great investments, but there are risks that are associated with those single family rentals that you don't really experience with these larger buildings. And it's why we're all in on apartment buildings.
Yeah. Well said, John. Well said. And that brings us to the last point is fear of losing when you invest because you just don't know that much about the investment. And, that fear of losing is a real thing. And, I definitely understand how you feel, investing in something that potentially you could lose. Like that is scary. I mean, you work really hard for it and ultimately you don't want to lose. And so that was actually to kind of pull us all together. One of the main reasons that John and I wanted to launch this podcast is so that we could help educate investors that are open to the idea of multifamily investing, but they just don't know all the details or they don't know enough to be able to make a educated decision. And, this is where there is like an ocean of information that's out there. It's like, well, who do you trust? And so with John and my background building, multi-million-dollar businesses in the past and building the reputation and being around for many, many years, we really wanted to provide that voice of trust for investors where you could actually learn the real deal, whether you're Canadian or American, learning how to invest in multifamily real estate and how you can get these higher returns and how to protect the downside. And that's what the show is really all about. And moving forward, as you listen to more and more, it's going to help equip you to make better decisions so you can sleep better at night and get higher returns at the same time.
Yeah, it comes to mind for me, Mark, kind of wrapping up, but you had mentioned that, you should have invested 10 years ago, but today's the right time. It makes me think of that Chinese proverb. It's, when's the best time to plant a tree? 20 years ago. When's the second best time? Today. And so, that's that idea, there's no time like the present to change up your strategy and take advantage of these exceptional returns.
Yeah, well said, John. Well, great chat here today. This is, I think we went a little longer than expected, but hope you guys got a lot of value from listening today. Thanks for listening, guys. If you enjoyed the show, please subscribe and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.